Last year, you worked. You earned money. You paid your bills. Maybe you even saved a little. And then, quietly, someone took a cut. No invoice, no receipt, no warning. Just less purchasing power than you had before. This is the tax you pay every single year without ever receiving a bill. It's called inflation, and it may be the most effective revenue system ever designed, not because it's illegal, because it's invisible. Right now, this matters more than ever. Across the world, from the Federal Reserve to the European Central Bank to the State Bank of Pakistan, central banks have expanded the money supply dramatically over the past decade. In 2020 alone, trillions of dollars were created in response to crisis. Most people remember the headlines: stimulus packages, emergency lending, quantitative easing. What they don't remember is the after effect. Prices adjust, salaries lag, savings shrink, quietly. And the strange part? The system is working exactly as designed. Let's start with something simple. Imagine there are only 100 apples in a small town at exactly $100. Each apple costs $1. Now imagine the town council prints another $100. No new apples, still just 100 apples. What happens? The apples don't magically double. The money did. Now each apple costs $2. No one announced a tax, but everyone holding dollars just lost half their purchasing power. That's inflation in its purest form. More money chasing the same goods. In the real world, it's more complicated, but the principle holds. When money supply grows faster than the production of real goods and services, prices rise. And here's the first uncomfortable detail. Most modern money isn't printed, it's created digitally. When central banks expand reserves, when governments run deficits funded by new debt, when commercial banks issue loans, money appears. Not backed by gold, not backed by physical assets, backed by debt. A mortgage creates money. A business loan creates money. Government bonds purchased by a central bank create money. The moment the loan is issued, new purchasing power exists in the system. That's how most money is born, as an IOU.
Now here's where it gets interesting. Governments spend more than they collect in taxes. Almost every year. To fund that gap, they issue bonds. Who buys those bonds? Sometimes investors, sometimes pension funds, and sometimes the central bank. When a central bank buys government bonds, it doesn't use saved money. It creates new reserves to pay for them. New money enters the system. The government gets funding, the public gets liquidity, and over time, if production doesn't keep up, prices rise. Slowly at first, then suddenly. You don't feel it in one dramatic moment. You feel it at the grocery store, at the rent renewal, in the shrinking size of products that somehow cost more than last year. No official letter says, "We reduced your purchasing power by 6%, but that's effectively what happened. Let's talk numbers. If inflation averages 3% per year, which central banks often describe as healthy, your purchasing power is cut roughly in half in about 24 years. Half. Work your entire career, save diligently, avoid unnecessary spending, and the currency itself quietly decays. Now imagine inflation at 6%. That's not a theoretical number. Many countries experienced that recently. At 6%, purchasing power halves in about 12 years. That's not long-term. That's one mortgage cycle, one child growing from elementary school to college. The math isn't emotional, but the consequences are. Here's the irony. Inflation is often presented as necessary. A little inflation encourages spending, discourages hoarding, reduces the real burden of debt. And that last point is critical. Inflation reduces debt in real terms. If you owe $100,000 and inflation runs at 5% while your wages rise, that debt becomes easier to pay back in real purchasing power. For households, that can be helpful. For governments carrying trillions in debt, it's extremely helpful. Inflation quietly shrinks the real value of what they owe, without voting, without legislation, without calling it a tax. Because functionally, it behaves like one. It transfers purchasing power from savers to borrowers, from people holding cash to entities holding assets. Now, let's contrast the public narrative with the underlying reality. Public narrative: inflation is caused by greedy corporations raising prices, or supply chain issues, or temporary shocks. Those factors exist, but sustained inflation requires one ingredient above all: an expanding money supply relative to output. Corporations can't raise prices across the entire economy unless consumers have the money to pay them. If everyone's income stayed fixed and money supply didn't expand, broad price increases would collapse demand. System-wide inflation is a monetary phenomenon, not a moral one. And here's the tension. Central banks are tasked with controlling inflation, but they are also tasked with preventing recessions, stabilizing markets, and supporting employment. Those goals conflict. When markets crash, liquidity is injected. When economies stall, rates are cut. When debt burdens rise, inflation becomes politically convenient. No central bank announces, "We prefer inflation," but the incentives lean that way. A slow erosion is easier to manage than a deflationary collapse, and slow erosion is harder for the public to mobilize against. There's another layer: asset inflation. When new money enters the system, it doesn't spread evenly. It flows first into financial assets, stocks, real estate, bonds. Asset prices rise before consumer prices do. Those who own assets benefit early. Those who rely primarily on wages feel the impact later, when living costs rise. This isn't a conspiracy, it's a structural effect of how money enters the economy. If newly created money moves through banks and financial markets first, asset holders stand closer to the source. It's like being near the top of a waterfall. By the time the water reaches the bottom, it's dispersed. That's why periods of aggressive monetary expansion often coincide with booming asset markets and widening wealth gaps. Again, no bill arrives in the mail, but the redistribution occurs.
Zoom out. Over decades, nearly every fiat currency in history has lost significant purchasing power. Not because of dramatic hyperinflation, though that has happened in places like Zimbabwe and Venezuela, but because of steady, managed inflation. A dollar today buys a fraction of what it did 50 years ago. That's not an accident. It's the architecture of the system. Modern economies are built on credit expansion. Credit expansion requires money creation. Money creation over time pressures prices upward. You can smooth it, you can target it, but you cannot expand money indefinitely without altering its value. That's arithmetic. Now, here's the uncomfortable question. If inflation steadily erodes purchasing power, and if governments benefit from that erosion through reduced real debt burdens, and if asset holders are positioned closer to newly created money, then who absorbs the quiet cost? Primarily those who save in cash, those on fixed incomes, those without access to appreciating assets. In other words, the most conservative financial behavior, saving currency, is structurally penalized over long periods, not through punishment, through policy design. None of this means inflation is purely malicious. Deflation can be devastating. A collapsing money supply can destroy businesses and employment. History has shown that too. The system chose a bias. It chose slow erosion over sudden contraction, predictable decay over unpredictable collapse. The question isn't whether inflation exists, it's how much is acceptable and who decides. Because every percentage point represents a transfer of purchasing power. Every expansion of money supply carries distributional consequences. And every year you hold currency, you are participating in that trade-off, whether you consented to it or not. So next time you notice prices creeping upward, or your savings earning less than inflation, or asset markets rising faster than wages, ask a simple question. If inflation is a necessary feature of modern economies, if it steadily reduces the real value of money, if it operates like a tax without legislation, then why does it rarely feel like a political decision? And more importantly, if this hidden tax is built into the system itself, what does that mean for anyone planning to save in the currency long term?